Okay, last video, I swear. I decided in chapter 10 I did more of a quick overview, but this time I decided maybe to do a little bit more. I did more questions in chapter 10, and I tried to take a different approach this time and maybe explain it a little bit more rather than do as many questions, but we'll see. We'll figure it out. So this is the last little bit here now. So we've already looked at they got rid of their assets, they allocated out the gain, they paid off their liabilities. So this is where things were prior. The entry for the sale of the assets, they got $46,000 in cash. So sporting goods, depreciation, accumulated depreciation, and their land were all now down to zero. They still have the accounts payable at that point in time, and then the gain was allocated to each of the partners. Then the next step then was to get rid of their accounts payable. So they paid out cash and paid off their accounts payable. So now we're left with $194,000 in cash and the 3 partnership capital accounts. So now the last step was to distribute that. So $72,000 for, well, each of their accounts, $72,068 and 54, were in a credit position. So we debit those accounts to bring them up to zero, which is reducing our cash to zero. So that's what happens if there's no capital deficiency. Now what happens if there's a capital deficiency? So that means one partner has a debit balance in their account right before everything ends. There's various reasons. Maybe they took a withdrawal right beforehand, but for whatever reason there's at least one partner that has a debit balance. So there's 2 things that can happen if there was a debit balance. So here we're saying that Davis has a deficiency, so a debit balance of $3,000. The partner can pay the deficiency, so the partner can pay the $3,000 that they owe to the business back. So here's what happens. Here's where they stood beforehand. Their account was negative $3,000. They pay $3,000 to bring their capital account up to zero, and that $3,000 then in cash gets added to the asset. So again, that's then afterwards we're going to record the final distribution. So the capital accounts, which have a credit balance, get zeroed out. So they have a debit entry, and then the cash again has a credit to zero it out to bring everything down to zero. The other alternative is if the partner cannot pay the deficiency. So if they can't pay it up if they can't or refuse or something to pay it back to the partnership, it's absorbed by the remaining partners. So there was a $3,000 deficiency, so to bring Chris's capital account back to zero, there was a debit balance, so it needs to be credited $3,000, and each of the partners remaining partners share in that deficiency, and they each take $1,500 as a debit to their capital account. And then this is shown here again. They start off in this position. Davis's account is brought up to zero in either case, but instead of increasing cash they're each sharing and reducing their capital account. So there's the entry then to record that final cash distribution. The $24,000 then gets split $17,500 and $6,500 to bring each of the accounts to zero. All right, that's the chapter. All right, so I'll come back and do a few of the questions as examples. Let me know if you have questions. Post them on a discussion board, please.